Hi, I'm Darcy Crow, founding portfolio manager at Crow Private Wealth. Welcome and thank you for joining us today. We are continuing to highlight best-in-class managers in various alternative investments in Canada, as this space is continuing to garner increasing attention by private wealth investors given the market environment that we're in today. Growth in alternative investments is one of the most defining themes in post-crisis era. So if you are not having conversations surrounding these investments, we think it really is important that you start that conversation. So we're incredibly grateful to our partners in lending us their time and providing our clients inside access to their management teams, often access that can be very difficult to come by. So with that, I'd like to introduce our guest today. Wayne Ehgoetz is President and CEO of Waygar Capital, which is the loan consultant for the Ninepoint Canadian Senior Debt Fund. Wayne has over 30 years of experience in Canadian asset-based lending, and prior to Waygar, Wayne was the group head of asset-based lending at Scotiabank, overseeing a $2 billion plus loan portfolio. So Wayne, thank you so much for taking the time to be with us today. You obviously have a very distinguished background in private debt in Canada, so we really appreciate your time today.
My pleasure, Darcy. Nice to be here.
Fantastic. So with that, I would love to maybe just start with an overview of your background in the private lending space. And I know when we chatted previously, you said you prefer the Godfather of Canadian private lending rather than grandfather. But I think just given the uniqueness of your background in the space, it'd be great just to get a quick overview of your experience.
Sure. Yeah. And you know what? Anything but grandfathers. So I've been involved in asset-based lending since it was introduced to Canada. I was fortunate enough to start the first asset-based lending group ever in the country. And then for the last 30, 35 years, that's all I've done. I just opened and started asset-based lending groups, all of which have either become the largest or the second largest in the country. And so I'm very narrow, but I'm very deep with respect to asset-based lending. And that's also reflected as well in my senior management team. Most of my senior management team have been with me not quite as long, but pretty much some of them almost. And between the 5 top senior management team, including myself, we have between 150 and 160 years of experience just in asset-based lending. It's pretty much all we know. And we've been through a lot of cycles. We've been certainly through even Y2K and 2008 SARS. So a very deep team that's been through the ups and downs of our economy with asset-based lending.
Yeah, absolutely. And it's not often you find that depth of experience in a team in asset-based lending. And I know that's a very reassuring to an advisor and clients as well. So fantastic. So to start, why don't we just talk about a general overview of the Ninepoint Canadian Senior Debt Fund. So if you want to touch on everything from, the objectives, the investments, the strategy behind it, maybe as well as the assets under management and the investor base that you have.
Sure. So we are a traditional asset-based lender. And by definition, we follow a very disciplined approach to these credits. And these credits that come to us, they come to us because they're generally not financeable by a Canadian bank. And the reason is it has no reflection of really how profitable they are. It's just the Canadian banks have a very distinct credit box, and you either fit in it or you don't. And they have to tick every single thing in the box. And if you can't have every box ticked, then you need financing outside of the Canadian bank. And so when they come to us, they're looking generally for operating lines of credit and term loans. And generally speaking, we will take out the bank entirely and we will provide the bulk of the financing to the company and become their primary lender. As a traditional asset-based lender, we have an extremely disciplined approach. So first and foremost, we look at the management team and the ownership team, and that's where you have to start, and you have to be extremely comfortable with that. And if we're comfortable with that, then we move to the collateral, because we really assess whether a transaction works on the basis is that if we had to liquidate the company and shut it down and sell all the assets and pay for all the professional fees and anything that might possibly prime us as a lender, if the answer to that is we wouldn't get all our money back and all our fees, we just won't do the transaction. So the transactions we do within this fund are highly secured and based on the premise, if the company goes down. And frankly, we haven't had one yet where a company's gone down in this fund. Don't expect to. But over the last 35 years or 100 years, depending who you're talking to, we have had to liquidate companies. We're totally prepared to liquidate companies. But that's our premise. So if we're comfortable with management and ownership, and at the same time we're comfortable with the collateral, we then rely totally on third parties to help us with that. So for example, with respect to the ownership and management team, we hire an independent third party to go and do criminal investigations as well as consumer credit investigations, which are very, very rigorous. We also then hire an independent third party to do the appraisals on all the assets for us, and they accept accounts receivable, and they establish what the values of those are on a liquidation scenario, and we will lend a percentage against that. So for example, if they say, on this glass here, in a liquidation scenario, all day long you get $1. So we won't lend $1. We'll probably lend 80 cents or 70 cents. So we even build in a buffer beyond what they say we can get. And then finally, with respect to the company, we use an independent asset-based lending audit firms, and they go in and they do a deep dive into the company, its performance, its payables. They do inventory test counting. They look at the receivable collections, and they give us an audit report. So before we look at a credit to do, we've done all of that. And so that's what a traditional asset-based lender does. They lend to the management collateral, and the premise of us lending is backed up by third parties. So that's our methodology. And then with respect to the fund, and I may be jumping ahead, I'm sorry.
No, that's great. I think let's do an overview of the fund, and then we can talk a little bit more about the areas that the loans are in.
Sure. Actually, that's what I was going to do.
That's where you're going. Okay, no, that's great, because that's definitely an area I want to focus on, because you guys do have those three really defined areas. So it would be great to get a little bit of an idea of those areas that you're in and why you find those areas so attractive.
Sure. So we have three distinct baskets, and for the most part, well, not for the most part, our methodology is the same that I just described. It's the same for all three baskets. So the first basket is really special situations, which could be late stage turnarounds. It could be bridge loans, companies that are going through more financial difficulty, like they have to do a restructure, a CCAA or a BIA, which people may be more familiar with the US equivalent, like a Chapter 11 or Chapter 7, or it might do a DIP financing. And again, highly collateralized. And a lot of times the reasons companies do restructures is not because of really performance levels, it's just their balance sheet is incorrect. That sector today represents 6% of our portfolio. The next basket is really almost the opposite. These are companies that are highly profitable, growing quickly, and the reason they can't get bank financing generally is their debt to equity ratio or leverage ratio that the Canadian banks use. And what the Canadian banks use today is a leverage ratio of 3-to-1, which means essentially for every $3 of debt they have to have $1 of equity on their balance sheet. And what you find quite often with highly growing companies, they just don't keep earnings, and they don't keep retained earnings. They spend it for their growth. Or in some situations, they've done an acquisition, and there's certainly an abundance of collateral, and there's a strong EBITDA, but again, their leverage is out. And so that today, frankly, represents well over 70% of our portfolio. So our portfolio today is heavily skewed to that basket. And then the third basket, which is around 24% of our portfolio today, is companies in the military and security manufacturing sector. And that box I described originally that the banks have, there are also industries that they will not finance. And the two that they won't do today are the two M's, marijuana and military companies, generally speaking. And we will not and do not do marijuana. But military we're very, very bullish on, because Canada, it's the best. It's a really amazing secret that Canada ranks in the top 4 producers of military and security products in the world. And there are over 2,000 companies in Canada today that produce products for military and security. And the reason the banks don't like military and security, there's 2. The first reason is reputational risk, because as soon as they hear military, they immediately think of lethal products. And if you really look at the industry here, by far the vast majority are not lethal. They're non-lethal products. They're protective products. They're, everything from, gangplanks to gears to gauges for planes. But it doesn't matter to a bank. That's the industry. It's tarnished. You can't get financing. And then some of the other banks, they won't finance because all of the banks have this criteria called concentration. And they do not like companies that have more than 10 or 15% of their sales with a particular entity. So some of these military companies, they could have 50 to 60% of their receivables coming from General Dynamics. Well, we don't have a problem with that at all. I mean, General Dynamics, very, very strong company. And also in that sector, most of these manufacturers are sole source. So if they're providing a gauge or a widget to General Dynamics or another end user, they're the only source of the product. There's no question that they're going to get paid for that product. So that's a big gap, and we're also very fortunate to have General Rick Hillier on our board. And Rick was our equivalent of the Joint Chiefs of Staff. He ran all aspects of the military, and he retired approximately 8 years ago. And he's been very key for us developing our military strategy. And every single transaction, of course, that is military on it, Rick is massively engaged on it. He's certainly got a much better perspective of the global requirement for military and security products. So those are our 3 baskets, and those are our percentages. And in a perfect world, I guess we'd like a third, a third, a third. But I think I'd rather have today the vast 70% being in that middle basket, which is profitable, strong EBITDAs. And the other thing I'd like to add is with COVID, 96% of our portfolio are essential service companies. And the reason for that is we really lend to old economy companies. We lend to manufacturers, distribution companies. Normally we would lend to retailers. That's a big part of asset-based lending. We don't have any retailers right now. We wouldn't do a retailer right now because we don't know where retail is going, what it's going to look like. Like today, it's got to be e-commerce really. So the brick and mortar retail stores is something we just don't touch. We see a lot of opportunities and we don't. And service companies. So by default, the service, the manufacturing, the distribution just tended to end up old essential service companies. So we went into COVID sort of that portfolio.
Okay, perfect. Well, I think that leads nicely into the next topic we were going to address, which is performance, and something investors are always keen to see. So would love to chat a little bit about both longer term performance of the fund and really specifically your experience throughout COVID and the market volatility we've seen this year.
Yeah, so it sort of speaks to itself, I would say, with the exception of March this year. I mean, we are really expecting returns between 8 to 9.5%. That's what we're targeting, and we really. I need to mention. I got to go to March. So if you look at our performance, really, it's been very consistent pre-COVID, throughout COVID, and it's reflective of the fact we just don't have any problems in our portfolio. In March 15th and thereafter, we started weekly calls with all our borrowers, and we still do it today. And we talk to our borrowers every week. We talk about what their sales are, how it compares to the projections. Are there any changes in their projections and their forecast? We do a collateral assessment to make sure that the collateral we lent against is still as strong as it was pre-COVID. And that's the methodology there. Now, with respect to the returns, what happened in March, which is the one I think I should really talk about, is up to March, we did a quarterly mark-to-market on our fund by an independent third-party accounting firm. And in March, like, nobody really understood where COVID was going. And the accounting firm and the global markets were going crazy. And there was really no view on what was going to happen. So the accounting firm did the correct thing. Well, they did the correct thing because they took a massive reserve on our fund, notwithstanding the fact that our fund is totally collateralized. But that's what they did. And by the time April came along and they looked at the methodology of our fund and understood how our fund was positioned, they basically reversed the write-down in March. And that write-down in March wasn't a reserve against any specific loan. It was just we're not comfortable with the global markets. We should, the prudent thing to do is take a write-down. So then when April came along, they reversed the whole write-down in March. And since then, we just tracked along. And the other thing since March is we now do monthly mark-to-markets. And so that accounting firm does monthly mark-to-markets. And then in addition, our auditor, KPMG, they also send that information to KPMG every month. So, because the last thing you want at the end of the year is our KPMG to say, now, hold on, we don't agree with the mark-to-market. We think you were maybe too liberal. You should have taken a further write-down. And so every month, in addition to BDO doing a mark-to-market, KPMG also opines on it. So, I just will say that I think that's the returns of our fund. It's been very, very steady, and we think we'll end up somewhere between 8 and 9%. And the other thing I should mention is we're in the process right now of negotiating a leverage line on the fund, which essentially means we get a line of credit against the assets of the fund, and we're looking at the area of about no more than a $50 million line. And the reason for that is that right now our partner Ninepoint funds us once a month. So if they fund us, just for an example, if they always fund us on the 15th of the month, we get the money on the 15th of the month, and that is problematic. It's problematic because we may have a loan that's not funding till the 25th. So that money that comes in from Ninepoint sits in our fund for 10 days, not earning anything, creates cash drag, and impacts the fund. And also, quite often, we might have a loan that we'd like to fund on the 5th of the month, but we don't have the funds yet from Ninepoint, so we have to wait 10 days. So the thing about a leverage line is the leverage line will give us this line of credit, and when we need to fund a loan, we can. And then as soon as the funds come in from our investor, we'll pay them down. And how that impacts the fund is it will increase our returns at least 1 point to 1.25. So, because it eliminates the cash drag. So we're hoping that once the leverage line is in place, the numbers you see in front of you annualized will improve by at least 1%.
Okay. Fantastic. But I think, regardless of taking that slight, you're still, flat on the month in March, and very, stable, steady return stream that you look to deliver. And I know that that's been very, very well appreciated by advisors that use it and clients. So I think it's been, done exactly what you set out to do. The other thing we had chatted about was opportunities that you're seeing, right now, given the uniqueness of the time that we're in. So would love just to hear from you, what the team's excited about over the next 12 to 18 months.
Sure. So we have 3 transactions we're going to fund prior to the end of the year, which will be between $50 and $70 million. So our fund today is a little over $250 million, and I think by the end of the year we'll be, 3 to 325. We have been a little, and our pipeline for the first quarter is amazing. We've got, you never say never. We're looking at a half a dozen to a dozen transactions. I would say if we could get 3 or 4 out of that, which we should, our first quarter looks great already. I would say, though, we are a little surprised because we expected the banks, given that the provision for credit losses, and just as you know, they've gone up every month, some banks more than others. We expected with the provision for credit losses going up from the banks, they would tighten up their credit sooner. And I think that, in fact, I think most of them have ramped up their special loans groups to handle problem loans. And we thought probably the fourth quarter, we would see more activity in the market in terms of transactions. And that has not happened. And for the most part, I don't think it's happened because there's still all these government programs with wage subsidies and other sort of loans that are propping up Canadian companies. But that will end. And I will also tell you that the experience that we are having, and we being, senior debt funds in Canada, is no different than what senior debt funds in the United States as well as the UK are experiencing. And when we talk to our counterparts there, they're a little surprised that the banks have yet to really kind of ratchet it down. And, part of that is the government programs. Part of that is the reputational risk issues. No bank wants to be seen as hard-nosed in the midst of a COVID environment, but there's no question they're going to do it. And so we're really excited about the first quarter. And generally our loans come in, we've got about 120-day forward outlook in terms of transactions. And we anticipate now the second, third, fourth quarter of next year are going to be unbelievable. And in fact, we've staffed up in anticipation of that. My philosophy has always been, I'd rather just staff up and grow into the staff than have it the other way around, where we're trying to staff up because the growth is too high for us, and then that creates problems. So we're extremely bullish on 2021. We think it's going to be incredible, just incredible. And the reality is, when the banks say no, the options for Canadian borrowers it's virtually nothing. There's a handful of senior debt funds in Canada. There's no sub debt or mezzanine financing to speak of in Canada. So then these companies' other option is equity, and the last thing they want to do is give equity away. So we are so well positioned because as you know, a number of the funds have gated. It's just a tremendous market for us, and the whole team they just can't wait. So it's a very good thing.
Okay, fantastic. Well, I think that that's given us a really, really great overview. And I know your investor base now. I know there is significant institutional, investor base. Would love to hear, from your own words, just given your, significant experience and background, why this strategy really makes sense today for private wealth investors in Canada looking for these types of opportunities.
Well, I think about it. I think where this product started, and I still remember, even in the paper, the Globe and Mail and the Post would always refer to asset-based lending as a lender of last resort, because we're sort of breaking some of the bank rules because we would lend to companies that wouldn't fit the box. And the fact is, asset-based lending in the U.S. is such a mature product. It's been there over 75 years. And in the United States, 60% of middle market America borrows by way of asset-based lending, and almost 22% of corporate does. So, typically the U.S. is 10 years ahead of us pretty much in everything. But, and if you look at asset-based lending in the U.S., which used to be dominated by private companies, then was dominated by the banks, and today is dominated by private debt funds. In the States today, really 85% of asset-based lending is done by private debt funds. And now let's look at Canada. Canada still, there aren't a lot of private debt funds doing it. We always follow the US trends, always, especially in lending products. And it really will eventually happen. The private debt will become, I wouldn't say dominant because we're a little different, but asset-based lending and private debt is going to become a growing product. And if you look at ABL as a whole, during good times and bad times, ABL always grows. it's recession proof and it's boom proof, and it always grows. And if you follow and if you stick to your core strategy, that you're only lending against collateral, you're only valuing these things based on a liquidation scenario, I just don't know how it just doesn't continue to grow and become more significant. Now, for me, I don't want any more competitors. I love it the way it is, but I know it's a matter of time till we get more players in the field. So.
Fantastic. Well, I think that's a great way to leave things off, and it's certainly a space that I'm incredibly excited to continue to grow. It's been a part of our allocations and our alternative portfolio, and it's really an allocation we're excited about for clients as well. So thank you. That was a really, really wonderful opportunity to hear directly from someone who is a founder and leader in the asset-based lending space in Canada. So we are very grateful for your time today. I do have to sneak in just to reiterate that these sessions are for information and are not a recommendation. So if you are interested in learning more about Wayne's product, the Ninepoint Senior Canadian Debt Fund, or any other alternatives in general, I'm very happy to speak to you about how that would fit in your portfolio. So please reach out anytime. So Wayne, thank you sincerely for your time. Greatly appreciated, and that's incredibly valuable input and experience that you've shared with us. And thank you everyone for tuning in. We will continue to highlight alternative ideas and managers we feel are truly exceptional in their respective spaces. So keep a lookout for future conversations to come. Thank you everyone, and have a wonderful day. Take care.
Thank you. Bye.
Bye-bye.